I'm Kurt Wagner in San Francisco, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, record highs. U.S. stocks reach new heights after the U.S. and China agree to phase one of a trade deal. The stickier portion, phase two, which includes cybersecurity and IT. Plus, executive insight. Former Cisco chairman and CEO John Chambers on his top tech calls for 2020. We'll find out what sectors he's betting on coming up. And 2019 in Rewind, the year that was. We examine streaming content providers as Disney and Apple enter the fray. What will 2020 hold when HBO Max and Peacock hit the market? But first, to our top story. U.S. equities climbed to a new high Monday amid hopes that a partial trade deal between America and China will ease a key risk for investors heading into 2020. With tech leading the charge, the S&P 500 index rose in the wake of the agreement. For more, let's bring in Bloomberg's Abigail Doolittle. Thank you, Abigail, for being here. Tech stocks and the stocks, of course, hitting more record highs today. Is this all about the trade agreement, Abigail?
Kurt, interesting question, because the euphoria that we're feeling today that's really taking stocks higher, it would feel that way. But I think an important point to remember is the idea that this year has been a huge rally year. So the trade agreement could really just be the frosting on the cake, because the stocks into October up 40%. So we do have very solid gains after that fact. But the tone was really set much earlier this year, it seems, with the Fed turning somewhat dovish earlier in the year. And last year, of course, we had that horrible fourth quarter. So investors and traders incentivized for big gains this year. We certainly have that. At this point, going into the end of the year, it feels as though traders, managers really trying to hang on to these gains and even stoke them. We didn't have a very bullish response on Friday. We seem to be having more of that happening today. And probably into the year end, barring any sort of, really shocking sort of an event that seems unlikely, at least right now, Kurt.
So now Susquehanna upgraded Western Digital today on non-recovery. And I know this helped out those shares along with Micron and others. But when we look at the terminal of NAND and SOX, is this justified?
Kurt, very interesting question, because last week also RBC was calling a bottom in NAND pricing. So what we're looking at there in white is the SOX, and you can see just up and away. I mean, this year it's up nearly 60%, the best year since 2009. That, of course, was coming out of the financial crisis, so that was that hand over fist type of buying. That's what we're seeing this year. And in blue, we're seeing NAND pricing. That is the type of pricing memory used in, say, iPhones and some other devices along those lines. It's going in the wrong direction. So a lot of these chip makers provide this kind of memory along with DRAM. DRAM pricing also in that area where it still appears to be bottoming. One thing I've learned through the years, very difficult to call tops, very difficult to call bottoms, maybe a little bit easier to call a bottom, but that chart doesn't look like a true bottom, at least yet. You want to see the move back up. That's not happening. Maybe these analysts, including at Susquehanna, are seeing something fundamental relative to demand that makes them think that. But it's not quite reflected in that chart of pricing, at least yet, Kurt.
Given all that, Abigail, what should investors be concerned about at this point?
Perhaps the biggest concern is really just the degree of this year's rally. I mean, you have the S&P 500 up more than 25%. As I was mentioning, the SOX up nearly 60%, tech up more than 40%, Apple up more than 70%, all of these all-time highs. So to have another huge year after those sorts of big gains, it seems very difficult, unless it's the euphoria of the late 1990s. Perhaps that will be true. But what it really does do is put square pressure on the fundamentals for companies to deliver. Something to keep in mind, we've been in an earnings recession. Now, the third quarter was better than feared. The earnings recession much smaller than expected. Most expect this to end in the fourth quarter of this year, the quarter that will be reported in January. But if that does not happen, that could really take a chunk out of the rally and make 2020 potentially difficult. Plus, trade, that agreement, it still needs to be signed. President Trump recently indicated that's likely to happen over the next few weeks. But then we're looking at the phase two, so we could have more uncertainty there. I think investors want as much certainty as possible. And 2020 could bring some new risks that aren't, priced in, at least right now, Kurt.
Certainly something that we will be following. Thanks to Bloomberg's Abigail Doolittle for that update. It's the final stretch of holiday shopping season, and shipping deadlines loom. But Amazon is blocking its third-party sellers from using FedEx Ground for quick prime shipments. The e-commerce titan cites a decline in FedEx's delivery performance. Here with the story is Spencer Soper, who covers Amazon and eBay for Bloomberg News. He joins us from Seattle. Spencer, what is happening here?
Well, you basically have a big fat vote of no confidence in FedEx from Amazon as we enter the critical, holiday shopping period. These are the days when people decide, am I going to buy this thing online and hope that it gets here in time for Christmas or not? And Amazon has really, increased the amount of time people are, or narrow the amount of time that people are willing to, make that call. Rub right up against almost Christmas Day. And so Amazon's saying FedEx cannot deliver its pledge for prime delivery, which is, usually 1 or 2 days.
Now, this sounds like a fairly routine thing for Amazon to do. I'm wondering, why is there heightened interest in this right now?
Yeah, so they do evaluate their service providers every year about this time, and that's when they figure out, when will our delivery cutoff be and who's going to, make the delivery, who can we count on, who can we not. But as Amazon emerges as more of a logistics provider, and it really becomes visible that, yes, indeed, they will be a threat to companies like FedEx and UPS, and they're creating their own logistics operation, that there's just heightened sensitivity to this kind of news. So that's why we see a little bit of a market reaction to the announcement today.
How are Amazon merchants reacting so far to this news?
So some merchants who rely on this service, if you basically got your holiday plan set out now and you know who your carriers are going to be when those orders come in, if you've committed a certain, to buying a certain amount of capacity from FedEx and you got a rate that you're comfortable with, and all of a sudden you find out that's not an option, this is extremely difficult for you. Now all of a sudden you have to find alternatives. UPS is going to charge you handsomely to deliver your packages at this point, if they even have room for them. So it's touched off a bit of panic among Amazon merchants who do use FedEx Ground.
Is there anything that they can do, or is this kind of out of their hands at this point?
Well, definitely out of their hands. I mean, they have, it's a race to find an alternative, and so that's the thing is we never know. Every year, every holiday season, e-commerce sales grow by double digits, and every year it's a new race to find new capacity. That's one of the reasons Amazon launched its logistics business to begin with, was simply to build capacity, because they saw demand that they thought their partners like FedEx and UPS didn't appreciate the extent to which e-commerce demand was going to grow. So basically they just have to scramble right now and find a truck that can take their package to their customer.
Spencer, obviously, regulators are looking at big tech right now for a lot of antitrust reasons. This seems like a power move for Amazon. Do you think this has any impact on the antitrust stuff that's currently going on in the tech industry?
Yeah, that's really interesting point on this, is because Amazon is an e-commerce platform and an e-commerce marketplace, and there's estimates that in the U.S., Amazon controls 70% or more of e-commerce marketplace sales. This would be a sale like an eBay or Walmart has a marketplace now, that Amazon clearly dominates online marketplace sales. If they can use that dominance to shift more business toward their logistics services, that can be an antitrust no-no. And so that's something that will be an important thing to watch, because that's something UPS and FedEx don't have. They don't have the online marketplace. And if Amazon is using that clout to peel business away from them, that could be something alarming.
Got it. Thank you. That was Bloomberg's Spencer Soper in Seattle. Uber defeated a court bid which would require Uber to reclassify its California drivers as, quote, employees. However, a judge refused to dismiss the case entirely, finding Uber drivers might be classified as employees under a 2018 California Supreme Court decision. It stemmed from a driver who filed a complaint saying that Uber failed to reimburse his business expenses due to how he was classified. Coming up, platforms and publishers. Big tech enlists moderators to help stop hate speech and report crime. But some moderators say the job is too much for their mental health. That story next. And if you like Bloomberg News, check us out on the radio. You can listen to the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Content moderation is becoming a bigger challenge as tech giants host more and more content online. And in an effort to prevent hate speech and hide graphic violence, moderators are being relied on to review and remove disturbing content. But many of those moderators are now coming forward, saying the job itself is causing trauma. Casey Newton has written about this extensively for The Verge. He has a new article out on moderator experiences at Google and YouTube today. He joins us alongside Bloomberg Technology's Mark Bergen. Casey, walk us through your latest investigation.
Yeah, so this story is basically two stories in one. I tell the story of these low-paid immigrant contractors who work in Austin, Texas, making $18.50 an hour, working on what YouTube calls the VEQ for violent extremism, and they experience a lot of mental health problems. And then I also tell the story of a young woman who was a full-time moderator at Google headquarters, had a great salary, gold-plated benefits, but after a year she got PTSD as well. So in part, it's a story about sort of the different levels of care you get depending on whether you're a contractor or not. But it's also a story about no matter how well you're paid, you still might get PTSD.
Yeah, you wrote a similar story or a similar investigation into Facebook's content moderator practices. Did you notice a lot of similarities between the two groups, or were there any differences?
Definitely similar in a lot of ways. For the most part, these companies operate this part of their business like call centers. But there are some notable differences. I think one of the big ones is that Facebook gives its employees about 9 minutes a day to decompress from the horrors of doing this work. Google actually gives them 2 hours. So that, I think, is better. That's one thing I would point to. But, the average moderator, I think, is having roughly the same experience at both places.
Mark, give us some historical context here around YouTube, Google, their policies. How have things changed over the last couple of years?
Yeah, I mean, the biggest change happened in 2017. That was when they had this big hiring. Google-wide, they hired 10,000 moderators. They haven't told us. I don't believe they told Casey how many of them are working on YouTube. The company YouTube really cut its teeth, if you remember, a decade ago with copyright, a fight with Viacom, DMCA, like all these sort of legal challenges where they have built up their liability. We are not responsible for the content on our platform. It's user-generated. We're going to police it to the best of our abilities according to our guidelines. But they had a very hands-off policy. And clearly, it's in 2017 was sort of a flashpoint year where they had a series of both advertising and content-related problems. And so they've decided to tackle this. But clearly, they have a long way to go. They, like Facebook, are also pushing for algorithmic and sort of machine learning systems to be the ultimate solution.
Yeah, and Casey, I remember a few months ago, Facebook came out, raised the minimum wage for a lot of their contract workers. I think a lot of people thought that might have been a result of your reporting. I'm curious, what has been the other fallout from this? What are you hearing from the companies in terms of their policies?
Well, the biggest fallout so far has been that one of the major companies that does this work, Cognizant, actually announced that they were going to exit the business a month ago. Some combination of brand risk and business troubles led them to say, the heck with it. And I think one thing I'll be watching next year is whether other companies decide they're going to get out of this as well. Frankly, I think a lot of these big consultants like Accenture are in over their heads. They see that giant contract. They want those $100 million or $200 million to do this work. Then they get those folks in the door and they find out that they're in way over their head.
Yeah, in order to do that, there needs to be another solution. Mark, you mentioned maybe transitioning a lot of this work to artificial intelligence. Facebook and Google have both said that's the plan at some point. Do you have any sense of how realistic that is, that humans could kind of step away entirely?
I think my understanding of the machine learning systems, understanding video and the amount of video that YouTube gets, like 500 billion hours every minute, it's still a long way to go. I think the more pressing problem is political, right? Where do you draw the lines? The companies have sort of built a system around child pornography and terrorism videos and this hashing system that they all use. There's this active debate this past year about sort of white supremacist and nationalist content. If that fits into they should categorize that and start taking those automatically. Of course, all the platforms are running up against this pressure and politically that they're being seen as anti-conservative. Mm-hmm. So I think that political problem will be a bigger hurdle than the technical one.
I mean, it seems clear to me that Facebook and Google are basically dealing with a lot of the same issues, but with, I guess, different policies. Are there any ways they're working together to tackle this?
Yeah, as far as I know, like I mentioned, the hash network they have around child pornography and Islamic terrorism, they're clearly working together behind the scenes to lobby against, say, the repeal of Section 230, which is protecting them from shielding them from a certain liability. I'd say they're working together probably, again, in DC to make sure that they can continue to have this user-generated advertising business model in the future.
Casey, when we read your stories and you hear the personal stories from the people you've spoken with, it's pretty disheartening, to say the least. Do you have any sense, or do these companies have any sense of the long-term impact of what this kind of work actually has on people?
No, and that's part of what I find so frustrating, is that these companies aren't making any investment in understanding the long-term impact of this work. Now, they are starting to do some sort of surveys about worker morale, but they're not isolating the folks that are in these queues where they're seeing nothing but violence or child abuse all day long to understand what that's doing. And that's the case even though for years now they've seen employees going to their manager saying, I need to take medical leave because I have PTSD. So they can't say they didn't know about the problem.
Looking ahead to 2020, you said you thought maybe some of these third-party groups might get out of this business entirely. Obviously, Facebook and Google still have billions of posts to be monitoring. What happens next year if that actually does happen?
These contracts are so fat that I'm cynical and think that there will always be some consultant that will step up and say, yeah, sure, let us give it a shot. We can do it. I think the bigger question is, what sort of workplace conditions will Facebook and Google decide that they can tolerate? Will they try to raise the floor on them, or will they sort of let what exists now continue?
Yeah. Well, both of you, keep up the good work. Thank you for being here. That is The Verge's Casey Newton and Bloomberg Technology's Mark Bergen. Thanks, guys. Coming up, how has rampant criticism affected social media platforms and their relationship with content creators? That's our conversation next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at QuickTake on Twitter. This is Bloomberg. 2019 has not been an easy year for social media platforms, with criticisms coming from both the public and politicians. How has the current climate impacted internet creators, the very people who have built careers on these platforms? To discuss, we're joined by John Shahidi, CEO and co-founder of Shots Studios. John, we just had a couple people in here talking about a lot of the issues these companies face with content moderation. Obviously, we've seen politicians rip on a lot of these platforms. You work very closely with them. I'm curious if all of this criticism in 2019 has affected your relationship with, the YouTubes and Instagrams of the world.
Hey, Kurt. No, it hasn't necessarily affected the relationship. You know, in the content world and all the platform worlds, you always have to adapt to new rules, new policies, algorithm changes, what the users want. So, it's just another thing that we have to adapt to.
I know that you work with a whole range of different platforms here. I'm wondering, when you go out and you're selling to a brand or you're selling to a partner, how do they view YouTube versus how they view Instagram or TikTok, all of these different platforms? Is there one in particular that they're more comfortable or less comfortable with?
The brands that we've been working with have been the most interested in YouTube. We have actually worked together with Google and FameBit alone to create content on, longer form content. I think brands have really, when they come to Shot Studios, they're interested in creating something that's more engaging and gets the longest length of eyeball time, and that's really YouTube, and that's where it's at right now.
It's hard to ignore the election that's going to happen in 2020. I know believe it was last month, Instagram said, hey, we don't want our content partners, IGTV said, we don't want our content partners doing political stuff. Is this something you think we're going to see a lot of in 2020? Not just maybe from you guys, but industry-wide. Is there going to be a lot of politics coverage from creators?
I think so. I think you're going to see creators speak up a lot more on different topics out there that are important, whether it's politics, whether it's climate change, whether it's debt. And I think you're going to see creators start speaking up more to educate their audience. That's something that we're looking into for next year.
What kind of stuff are you guys, what kind of stuff do you have in the hopper, I guess? I know on the journalism side, oftentimes we have kind of a 2020 coverage plan. I'm sure you have something similar at Shot Studios. What kind of stuff are we going to see from you?
Over the last 3 years since we made the pivot into Shot Studios, our focus was comedy, and we've created a big audience that's enjoyed watching our comedy videos. The last year and a half, we've gotten into music, and we've used YouTube to successfully launch some music careers, including the one of Lele Pons. where comedy and music are still going to be our focus. But in 2020, it's such a big, important news year that I believe, and we're gonna start creating more educational and videos that are really gonna like inform our audience on what's important in the world.
Yeah. I know we mentioned IGTV a little earlier. It's interesting, you were at the launch of IGTV, which I think was about 18 months ago. Mm-hmm. It doesn't feel like it's really caught on in the way that Instagram probably hoped. I'm wondering, do you think that's a fair assessment, and what do they kind of need to do to get IGTV more on the map?
You know, I think it takes time. The user behavior on Instagram was so different than a video platform, and I think it just takes some time. It took YouTube some time. 10 years ago, you were watching just quick home videos on YouTube, Charlie bit my finger type of videos, and then 5 years ago, it was kind of odd to watch a 5-minute, 6-minute plus video on YouTube, and now if you go on the trending section on YouTube, half the videos are over 20 minutes long. Some of them are even 30, 40 minutes long. It just takes a while to create user behavior, and I think it's going to take Instagram a little bit of time. I'm a believer in it personally. I just think it takes some time. 18 months is really short to have a platform that's almost 10 years old adapt to long form video when everyone's been used to uploading photos and short form video.
One of the ways Instagram made a lot of news was they said, hey, we're going to test removing the like counts from the feed. As someone who manages people who get a lot of likes on Instagram, how does that sit with some of your creators? Is that something that you are thinking about or that they are thinking about?
It's going to be an interesting move. Kurt, I'm an advocate of positivity online, and I think removing likes will harm the business a little, but I think it will help it in the long run. I think, when you get out of the business of comparing yourself to others and overthinking posts, and then comparing posts to previous posts, and start thinking, then that's where creator fatigue comes in. That's where the sadness online and the toxicity of social media comes in. And, I think when you start removing that, I think then you just share what your life is about, and that's what social media is about.
Great. John Shahidi of Shot Studios, thank you so much for joining us. Coming up, taking the social scene by storm, how VSCO is taking on Instagram without likes or comments. That's next. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Kurt Wagner in San Francisco with Sherry Ahn in New York and Paul Allen in Sydney. Let's take a look at the top global tech stories of the day. Paul?
Thanks, Kurt. Travis Kalanick is getting out of Uber Holdings quickly. The co-founder of the ride-hailing service has sold 350 million more of his shares this month. That brings his proceeds to more than 2.1 billion since a lockup ended on November the 6th. Kalanick's remaining Uber stake now amounts to about a fifth of his $3 billion fortune, and that's down from about 75% before he started selling. Masayoshi Son's Japanese bankers are taking a hard look at their most important client. Some have said privately they're less comfortable with the eccentric billionaire's management of SoftBank's $100 billion vision fund. SoftBank reported a $6.5 billion loss in the last quarter, and that's blamed on falling valuations on investments in WeWork and Uber. Billionaire Dallas Mavericks owner Mark Cuban is selling one of his sports tech investments. The owner of the Los Angeles Dodgers are buying data and analytics company Synergy Sports Technology. Cuban is the biggest investor. Bloomberg's learned the price was about $90 million. Synergy provides its analytics tools to a number of professional and college sports teams. And those are the top global tech stories that we're watching. Kurt.
It's a social media platform that's redefining the way Gen Z is posting. VSCO is a network without likes or comments that's taken the social media scene by storm. Its users have inspired memes and have even generated a population of internet users dubbed VSCO girls. We're joined now by co-founder Joel Flory. Joel, you guys have been around since 2011, I believe, and I feel like this summer was really the big moment for you with this VSCO girls meme. I'm wondering, how does that happen this far into your life cycle?
we've been growing, and it's something that we've seen this rising trend, but definitely this summer with the meme, it took to all new heights. And I think a lot of that has been a lot of how we built it from the beginning. So VSCO was built without likes or comments. It was a safe space for you to be who you are, just to create and express yourself. And what we're seeing is, in particular with Gen Z, which makes up over 75% of our 20 million weekly active users, is that they're looking for this outlet where they can share how they see the world. And we're just seeing that start to really rise.
The thing about social media and what attracts some of these young people is the engagement that you see, right? So how do you compete with apps like TikTok, for example?
So we think of it less of competing with apps like that, and more when you talk with Gen Z, what you'll hear them say is that it's really like a social operating system. They know the app they're going to use for one-to-one messaging, one-to-many, or to broadcast a message to as many people, or in TikTok's instance, really to find humor and fun and really pass the time. For VSCO, it's not about sharing how you want the world to see you, but it's really about sharing how you want and how you see the world.
Unlike most social media platforms, your business is not advertising dependent. You have a subscription offering. I'm curious, how do you convince people to pay for something when oftentimes they have a lot of other free outlets to post or share?
From the beginning, VSCO's built something of value that people would be willing to pay for. So there's always been a component of paying for presets or tools. And with the launch of our subscription in 2017, we really brought that together into a complete package, but delivered a lot more around the experience. And so last year, we launched with video. It brought our membership up to over 2 million members, and we're seeing that growth continue to really grow.
So tell us a little bit about your acquisitions and how you plan to grow besides just editing and photo sharing.
So like I mentioned just previously, one of the biggest growths to our membership last year was unlocking video functionality within the app, but it was pretty lightweight. And so with the recent acquisition that we made this past week of Rilo, which was a team that previously had worked on iPhoto and hyperlapse at Instagram, really excited by the technology they were building for a consumer mobile app that they were just about to launch. And in helping advise them on that launch, really decided this would be better in VSCO.
You just completed a new study, I believe, on Gen Z. These are a lot of your users, teenagers. What was most interesting that you learned from that group?
So something that wasn't surprising, we surveyed over 1,000 Gen Z members on VSCO's platform. And one thing that wasn't surprising to me was that, over 56% mentioned that through social media, they've been able to find kind of their group, their friends, or where they fit in. And a lot of that was also around 46% of them identified as an activist through this, or 46% identified as creative. The flip side of that is that 41% said they were feeling really anxious about going home for the holidays and not being accepted for who they are. And this is really something that I think it's grown at a much larger scale, where 46% said they feel judged by their social media posts. When I was young, it was really only ever like what I said around the table, and now I can't even imagine going home for the holidays and having my entire family judge everything I'd posted for the previous year.
Yeah, I'm not sure if that's Gen Z specific. I'm sure a lot of others
people feel that
can
pressure.
relate. We were talking with John Shahidi just earlier about Instagram's decision to test removing likes from the feed. Now, you have not ever really had like counts on VSCO. Tell me about the decision to do that. You're kind of ahead of your time a little bit, if you think about it like that.
So we were very intentional, and I think one of our biggest inspirations around that was like an actual museum. When you walk into a museum, you're not seeing the net worth of the creator there on the wall. You're not seeing how many people have walked through that museum that day. And you're definitely not seeing a bunch of like emojis at the bottom of the piece of work to tell you what to think about it. And for VSCO, it was, how can you have this personal connection, and how does it inspire you to go out and create? And so from the beginning, we architected our community that way. And we really do welcome others to that, because it really is a positive step in the right direction for mental health and the impact that social media has on people.
Yeah, we'll be interested to see if that translates to some of these bigger platforms as well. That was Joel Flory, the CEO of VSCO. Joel, thank you so much for being here. Plenty more global stories ahead. This is Bloomberg. This week, we are rewinding time and taking a look back at the 2019 to bring you the biggest tech trends. Now, big tech companies like Facebook, Twitter, and Google headed to Capitol Hill to testify in front of Congress in regards to potential regulation. The biggest tech unicorns headed to New York to hit the public markets, while others had less success. And of course, the year wouldn't be complete if we didn't mention the streaming wars.
One of the biggest trends to date is cutting the cord. There's an endless amount of content to watch if you're streaming, and the list doesn't seem to be getting any shorter. By mid-2024, the most valuable companies on the S&P 500 will introduce their own streaming services. They're spending billions of dollars in order to compete with established players Netflix, Amazon, and Hulu in what's become known as the streaming wars. Disney Plus and Apple TV Plus kick things off in November. At $6.99 a month, Disney Plus costs about half as much as Netflix and offers a library of programs designed to be irresistible to families. Apple TV Plus is cheaper at $4.99 a month, but only a small library of original programs headlined by a drama called The Morning Show. Two other services to watch out for mid-2020, HBO Max from AT&T and Peacock from Comcast. So why now? The more people cancel their cable and satellite subscriptions and the higher Netflix's stock rose, the harder it got for those companies to ignore the change in viewing habits. In an October poll of U.S. consumers with broadband internet by Hub Entertainment Research, 63% said they watched their favorite show online. And with U.S. producers making at least 100 more shows per year now than in previous years, the pace doesn't seem to be slowing down. Taylor Riggs, Bloomberg News in San Francisco.
To further discuss the streaming wars of 2019, we're joined by Rich Greenfield of Lightshed Partners, and also with us is Greg Portell, head of global consumer industries and retail practice at A.T. Kearney. Now, Rich, I want to start with you. If on the surface, when I think about all of these different services, I think that they're all just going to be competing with each other, kind of eating each other alive. You don't really see it that way. Why is that?
I don't. I mean, I think that's the real fallacy. I mean, we like to call it streaming wars, and I think the press and sort of the industry likes to talk about one of these eating into the other. But the reality is we're going to see an explosion of streaming services. The consumer wants to stream video. You've seen it, obviously, with what's happened with Netflix and Hulu and Amazon. But even look at YouTube and look at how much time is being spent. And you've got Jeffrey Katzenberg introducing Quibi next year, which wasn't on your list. But everywhere you look, that there's more and more content. People want to stream content. The reality is the consumer is spending right now $80 to $100 a month for linear TV packages. You've still got 85 million subscribers to multi-channel television. My guess is that the number of homes that actually have to have sports and news, and the only way they can get that is through a linear TV package, that's 40 to 50 million homes. And so you've got 30 to 40 million homes that are going to come out of the pay TV bundle, the big kind of cut the cord type bundling, and they're going to find new ways of getting content, and whether it's Netflix or Amazon or Hulu or Disney Plus or Apple TV Plus, all of these are far easier and cheaper to subscribe to than cable was. You can sign up, you can cancel, you can have a few of them for a period of time. This really empowers the consumer to create the bundle that they want versus being forced to take channels that they never wanted. I mean, how many people are paying $9 to $10 a month for ESPN and never ever watch it?
Greg, I do feel like this can be somewhat confusing to the general consumer when you think about all these different players, all the different price points. Obviously, some of them are already advertising, but they're not yet available. I'm wondering, are these streaming services doing a good job of actually marketing themselves, and how is that actually playing out?
Well, one of the challenges they have is they are drawing so much attention. So the narrative around these streaming services, what they're going to offer when, is very difficult for them to control. And that makes it pretty challenging for them to get the right message out around price points and when content's going to be available. As we were mentioning, we're already talking about content and networks that are going to be available in 2020. And that kind of mutes the conversation about what's available today.
One of the things I was just going to say, one of the things you should think about is that the consumer really looks to one of these services to focus on. Like, every streaming service needs to create addicts. The services that have one show or two shows that you're watching, you're not going to build that habitual daily behavior where you just go on there looking to watch something. So you may go on to Disney Plus because you want to watch Mandalorian, but Kurt, there isn't a lot for you to go on as an adult unless you want to go rewatch old Marvel or Lucasfilm shows. There isn't a lot to actually watch. And so when you're thinking about where do you build that daily behavior of going on to find something to be entertained, sort of like when you turned on your cable box and you scrolled through trying to find something to watch, I think that's what Netflix has really tried to create, where there's something for everybody, and there's always something new. There's always a new show coming onto the service, and they're trying to build that addictive behavior where every night you're going back looking for something new or continuing what you were doing last night. That's very different than most of these other services that are not really in that same game.
Rich, you mentioned the Mandalorian and the Disney Plus service. Obviously, Apple Plus is also trying to do a similar kind of big highlight shows to get people interested. I'm curious, how do you feel that those two in particular have really hit the market at the tail end of this year?
I mean, I think it's hard to deny that Disney Plus has been an incredible early success story. I mean, they're already announced 10 million subscribers on day one. Obviously, part of that is people who locked in multi-year deals and people who took it free through Verizon. But still, it's a staggering number. Kevin Mayer and the team working for Bob Iger on rolling this out did an incredible job, and they're probably heading towards 20 plus million subscribers by the end of 2019. So in a couple of months, they will have added, 20 million subscribers. That's just a staggering number. Now, the question is, how do you grow from there? And I think there's obviously going to need to be a lot more programming in order to keep you interested. Remember, right now you're burning through a lot of library. People are going and rewatching Hannah Montana, rewatching Wizards of Waverly Place. When they get through that, though, they're going to realize that there isn't a lot of fresh content, especially for a more mature audience. And I think that's where it's really going to be interesting to see how much does Disney invest and how much are they relying on kind of legacy movies and legacy content, and will that really be enough to mitigate churn? We'll certainly see. Our guess is that you start to see Disney spend a lot more money and also collapse windows so they get their movies like Frozen 2, which just came out, won't be on Disney Plus for 6 months. My guess is those windows start to close. On Apple, look, it's very, very early. Apple's playing the long game here. There is a lot of content coming. I wouldn't judge Apple by what they've done so far. I think they're pretty pleased with how some of their shows have done initially, more US than global. But I think there's a tremendous cadence of original programming. Look at Apple in a year, and I think you're going to see a very different service with a lot more to do. The M. Night Shyamalan show, Servant, just came on a couple of weeks ago. You're going to see a much more robust offering over the next 12 to 18 months out of Apple.
Greg, we've been talking about cord cutting now for a number of years, and I know that it's moving pretty quickly in the world of technology, but it's still kind of slow for some consumers to get there. I'm wondering, is there anything specific that's going to happen in 2020 that makes you think this might be a banner year for the actual cord cutting?
Well, I think the expertise that the companies have in terms of getting the right content to the right consumers in the format they want is really what will accelerate that cord cutting, because what consumers want is they want control. They want the ability to choose what they watch, when they watch, how deep they watch it, and how much they explore. So the companies that are in 2020, as we start seeing companies get more sophisticated in how they bundle and how they package, that's going to start tipping over those consumers that have been sitting on the sideline waiting to see what happens.
But Kurt, remember, when you think about your viewers, there was a sense just looking at the broader media space. I mean, if they were watching what some of these executives were saying, most of them were talking about, if you looked at kind of this point last year, so late 18, most of the executives from media companies were talking about cord cutting slowing. They were saying things were getting better because of the Hulu Lives and the YouTube TVs. And here you are a year later, and you've gone from 1% to 2% loss of subscribers to you're going to exit 2019 probably at down 5%. I mean, we have never, ever in the history of this industry seen a 5% drop year over year in subscribers. I think a lot of them hope it stabilizes or gets a little bit better in 2020. But when you look at what you just showed in that, kind of that promo heading into this segment of all the services that are coming on, and then you go into all the content on all of those services, it is really hard to believe that the trends that started in 19 don't exacerbate meaningfully in 2020. And I think you could see 5 to 7% loss of subscribers in 2020. And that's really where I think you start to get real fear about what cord cutting is doing to the legacy media industry.
Well, the question that comes up to my mind when I think about that is really, is it cord cutting or is it switching channels? Because you have to have an alternate way to monetize those eyeballs. And the companies that are moving into this space now are creating that path to capture the new digital consumer, similar to the way retailers did when they started building up their .com capabilities.
The only difference being, obviously, Greg, that you have different levels of profitability. I don't think there'll ever be a business as good as legacy cable networks. I mean, if you think about at the peak, 100 million people paying for ESPN, $9+ a month or $8+ a month, when probably no more than 20 to 25 million wanted to pay for it. The idea of paying for something monthly all year at a very high price that you actually don't want or even use, that's very hard to create in a digital world where, again, presumably, when you think about Netflix's 158 million global subscribers, presumably none of them actually are paying for it who really don't want it because it's literally click to cancel. And so you're moving from a world where there was a lot of what I would call breakage, where people were paying for something they didn't want, to now you have to earn every single subscriber that comes onto your platform.
Good. Thank you, gentlemen, both. I appreciate all of the thoughts there. We're going to end it there. That was Lightshed's Rich Greenfield and AT Kearney's Greg Portell. Thank you guys both for joining us. Still ahead, only a couple of weeks left in 2019. Industry executive John Chambers will tell us his predictions for 2020 and what sectors he's betting on. This is Bloomberg. Not a good year for some tech names. We've seen companies like WeWork back out of their public listing plans, while others, including Uber and Lyft, are trading well below their IPO prices. Here to talk 2020 predictions and what he thinks are the top tech calls for next year, we have John Chambers, founder and CEO of JC2 Ventures. Chambers is also the former CEO of Cisco. John, thank you for being here.
It's a pleasure again.
We said 2020 predictions.
Yes.
Let's get right after it. What's going to happen next year?
Well, this will be fun. We'll take a little bit of risk, and if we hit them all, you and I are going to Vegas.
Yeah,
so I'm
I
going to
like
go out there a little, getting people outside their comfort zone. First prediction, contrary to what everybody's saying, I don't think there's going to be a major change in the economy in 2020. I've heard for 3 years how everybody thought a recession was just 12 to 18 months. It's continuing too long, et cetera. I think at the end of this next year, we'll be sitting here in this session in December and say it was another solid economic year. The geopolitical issues will continue to be challenging, lots of ups and downs and surprises during the year. But I think the Fed, for the first time in my lifetime, has been proactive. So I think the economy this next year will do solid. So my first prediction is it's going to be a good, not great year. Second, in terms of technology, the next major technology behemoth that's going to come out of artificial intelligence, computing, cloud, networking, everything moving to the edge, and the Internet of Things with 500 billion devices. So we've always had a change about every 10 years in the next major leader. I think one of the startups today is going to emerge, and you'll look back and say that was the next Apple, that was the next Google, et cetera, that came out of this era.
And who's it going to be? Are you saying?
I think it'll be one of the startups, hopefully one of mine. We'll see. I have startups like ASAP that is as good as it gets in artificial intelligence, and average order is 15 million, and none of your readers have ever heard about them, to a company like Unifor that basically is maybe on the fastest path to unicorn status. All of them with very good profitability and free cash flow as well as growth. That'll be the third projection. It was a poor year for startups.
It was.
45 or 50 of them got pulled from the market this year, about up 50% from last year. Many of the companies' best day was right after they went public. I think you're going to see a return back to the future. It's going to be not just about growth, but it's about profitability and free cash flow. I think next year is going to be a super year for startups, but it will be those who learn to focus on profitability and free cash flow. Tough thing to do, Kurt. If you haven't built that into your culture, I don't care how good the CEO is, making that transition is hard.
Tell me a bit about China. Obviously, that's the topic of conversation now. We're talking about a trade deal between the U.S. and China.
Yes.
Is the tension going to continue well into 2020?
It's going to continue. First is I've been a huge backer of China. First big decision I made in '95 was to double down on China at Cisco. Before that, I was with Wang Laboratories. Huge believer in the Chinese people. But it developed into a win-lose scenario with the U.S. losing. Shame on us for getting pushed around a little bit and not being tougher on negotiations. So the changes in terms of getting a reasonably level playing field where American business and therefore job creation in America has a level playing field in China, just like Chinese business has in the U.S., has to be fixed. Intellectual property, security, et cetera. So phase one was a good first step. It was just that. I think it's so important that we don't back off in terms of areas that have to be resolved in terms of that level playing field, intellectual property protection, and security. So I think we'll navigate through that. To the question you didn't ask me, next president,
I was just going to say, you said during the break you were going to call the election, so let's hear it.
Well, we'll see how close we are. Back in May of 2016 on TV like this, when Hillary was ahead by 10 points, who I voted for, by the way. I said, are you asking me who's going to win or who am I going to support? And they said, who do you think is going to win? I said, Trump. I think people were making it too complex. America wanted change, especially the central part of the nation and the Southeast, whose dream of America's future was going behind. Who's going to win this time? It will be Trump if the Democrats stay on the left. And so if they take one of their front runners today and run it against President Trump, he will win. If the Democrats move to the middle and get a moderate, then I think the Democratic moderate person will win.
Well, we will hold you to that. And like I said, if you get it right, you and me going to Vegas next year. That was John Chambers of JC2 Ventures. Thank you, John, for joining us. That does it for this edition of Bloomberg Technology. Bloomberg Technology, of course, is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at QuickTake on Twitter. This is Bloomberg.